Hello everyone. In this presentation, I am going to talk on options, which is a part of a derivative market. This topic is useful for the students of money and banking, BCom honors students, and money and financial markets and financial economics for economics honors students. Now, what are options? Options are the type of financial contract which gives the owner of the contract the right but not the obligation to buy or sell the financial assets at a specified price to another party at a specified date. The buyer of a contract must pay the seller a fees which is called the option price or the option premium. Options are of two types, call option and put option. Now, what is call option? Call option is an option grant to the owner of the option the right to buy a financial assets from the other party. And put option is the option that grants the owner of the option the right to sell a financial asset to the other party. In option market, we have a strike price. It is the price at which the underlying asset may be bought or sold. It is also called as an exercise price. Then we have a specified date where the writer or the seller of the option grants the buyer of the option the right but not the obligation to purchase from or sell to the writer something at a specified price within a specified date. Then the expiration date, the date at which the option expires. It is also called the maturity date. And lastly, the option premium, where the seller grants the right to the buyer in exchange for a certain sum of money, which is called the option premium or the option price. On the basis of expiry, options are of two types, American option and European option. American options are the options which can be exercised anytime up to and including the expiry date. But European options are exercised only at the expiration date. Now, one important characteristics which differentiate options from the futures are that in option market there is no margin requirement once the option price or a strike price is paid in full. Option price is the maximum amount the option buyer can lose no matter how adverse the price movement of underlying asset. No margin is needed in options. The writer of the option has agreed to accept all the risk and none of the reward of the option in the underlying asset. The writer is generally required to put the option price received as margin. The price changes occur that adversely affect the writer's position. The writer is required to deposit additional margin as the position is marked to market. Options are traded both on the organized exchanges and over the counter. Exchange traded options are standardized options in terms of exercise price, quantity and expiration date, where over-the-counter options are non-standardized in terms of price, quantity and expiration date. Exchange traded options are more liquid and it has a less transaction cost. Along with that, it has a clearinghouse facility associated with exchanges to solve the counterparty risk. Over-the-counter options are less liquid, they have more transaction cost and they have no clearing houses. Now let us see how options are different from future. Option buyer has the right but not the obligation to exercise the option, whereas option seller or option writer does have the obligation to perform if the buyer of the option insists on exercising it. So in option market, buyer has right but not the obligation. But in futures, they are the legal agreement where buyer and seller agree to transact with respect to some financial assets at a predetermined price at a specified date in future. Both the buyers and the seller have rights and obligations in the future market. In options, fees are option premium, but in future, both the party are obliged to perform, neither party charges any fees. Option buyer pays the seller the option price or the token, the price which the buyer pay to the seller to come into the deal. While in futures, the buyer does not pay the seller to accept the obligation. Options do not provide symmetric risk-reward relationship. The most the buyer of option can lose is the option price, and the maximum profit writer of option can realize is the option price. In option market, there is no margin requirement once the option price has been paid in full. The maximum amount the investor can lose in adverse price movement is the option price. While in future, the buyer of a future contract realizes gain when the price increases and suffer loss when the price decreases. In future market, there is a margin requirement in form of initial margin, maintenance margin and variation margin. Now let us understand the risk-reward characteristics of the option on the basis of 4 basic option positions. To understand that, first of all, we should know that in option market, for buy we say long and for sell we say short. So the first is buying a call option or long call. Second is selling a call option, short call. Third is buying a put option, long put. Fourth is selling a put option, short put. Now let us understand the option position with the help of price action. There are 2 types of price action. One when the prices are rising and another when the prices are falling. When the prices are rising, the market is called the bullish market and we go long. We take a long position, that is buying a call. The buyer of a call option pay option premium and he buy at a lower price and sell at a high price and book the profit. But when the prices are going down, we call a market as a bearish market and we go short. In options, we said this market as a buying a put. Buying a right in a put option by paying an option premium, we sell at a high price and buy at a lower price and book the profit. Now to be more clear on price action, let us understand the candlestick chart of Nifty. In this chart, you can see here the prices are falling and the market is bearish, and here the prices are rising and the market is bullish. So when the prices are falling, we take a short position where we sell at a high price and buy at a lower price and book the profit. But when the prices are rising, we take a long position where we buy at a lower price and we sell at a higher price and book the profit. Now let us discuss the option positions. The first is buying a call option or long a call option, or simply we can say long call. And the second one is writing a call option or selling a call option, or simply we can say short call. Now let us understand the long call position with the help of insurance industry. Insurance are now the part and parcel of our life. We have home insurance, car insurance, health insurance, travel insurance. So insurance is very common in our life now. In this example, Mr. Bob and Mr. John are very happy to buy insurance. Mr. John and Mr. Bob feels that by buying the insurance, there would be no financial risk for unforeseen circumstances. Now, how do this insurance industry work and how do Mr. Bob and Mr. John will get the benefit of insurance? So to get the benefit of insurance, Mr. Bob and Mr. John has to pay the insurance cost in terms of insurance premium. And if something adverse happens in future, they will be entitled to get the full amount in claim. So to get this full amount, they have to pay some cost, which is insurance premium. Now, what is the business of the insurance industry? Insurance industry business is the insurance premium which it receives from the people, and the claim which insurance industry made is the loss of the insurance industry. But we always see that the claim are much lesser as compared to the people paying the premium amount. So Mr. Bob and Mr. John are having a limited loss by paying a premium to get unlimited profit if something goes adverse. But if something goes adverse, insurance industry will be having unlimited loss and only limited profit, which is coming in form of insurance premium. But if everything is normal, insurance industry will be only getting its limited profit and no unlimited losses. So this is the way how insurance industry work. And let us understand now the long position of an option, call option. Now let us understand the option position. The first is buying a call option or long a call option or long call. To understand it, let us have some assumptions. The call option, the underlying asset is XYZ, which has a time of maturity of 1 month. Strike price is 100, option price is 3 and the stock price is 100. There is no transaction cost. Now the question is, what is the profit and loss of an investor who purchased this call option and hold it to the expiration date? So the profit and a loss from the strategy will depend upon the price of the asset at the expiration date. So to understand it more clearly, let us see the table. Now let us understand the profit and a loss of buying a call option with the help of this table. First of all, we should know that the cost of buying a call option is strike price plus option price. So we find the profit by deducting the strike price plus option price from the price of an asset at the expiration date, that is stock price. Now let us see in this table. Suppose the price of an asset at the expiration is 150. The profit of a buyer for buying a call option is 47 rupees, that is 150 minus 103. When the price goes down, price falls to 111, the profit of a buyer falls to 8 rupees. Suppose the price further goes down and price of an asset at expiration date is 103. So the buyer is in a break-even position, neither profit nor loss. If the price further goes down to 102, the buyer will be in the loss of 1 rupee. If the price is 101, the buyer will be the loss of 2 rupees. Now the interesting part comes here. Suppose the price further fall down, it becomes 100. So the loss of the buyer in call option is only 3. If the price fall down further, the loss of the buyer of a call option is only 3 rupees, which is the option price or the option premium which he paid to come into the deal. That is the price which the buyer pays to get the right to buy the option contract. So the loss of the buyer of a call option is limited to the option price. Now let us understand the call option more clearly with the help of this figure. So first of all, to buy a call, we have to pay the option premium. That is the token amount which the buyer has to pay to come into the deal. So here the buyer is paying 3 rupees, which is going out of the pocket, which is going out of the pocket of the buyer. So it comes in a negative axis, negative zone. Now let us see what happens when the stock price at the time of maturity is 103. So at 103, buyer is in neither profit nor loss because the stock market price and the total option cost, that is strike price plus option premium, is 103 and is a break-even point. Now what happens when the price goes down to 101 and 102? When the price goes down to 101, the loss will be minus 2. When the price goes down to 102, the loss will be minus 1 if the buyer exercises the option and minimize the loss. But what happens when the price goes down to 100? The stock price is 100 and the option cost is 103. The loss will be minus 3. But if the price goes down to 90, the loss will be only minus 3. If the price goes down to 80, the loss will be only minus 3. If the price goes down to 40, the loss will be only minus 3. That is, the loss is limited to the option premium, the token amount what the buyer has paid to come into the deal to get the right to buy the call option. Now, when the price goes high, the stock price increases at the time of expiration. Suppose the stock price increases to 110. Then the buyer of a long call will be in profit because the stock price is 110 and the option cost is 103. If the stock price is 120, his profit will increase because the stock price is higher than the option cost. So here, as the price goes high and high, the profit from the long call increases. So in one line, we can say that long call has unlimited profit, but it has a limited loss when the price goes down. Unlimited profit as the stock price goes up at maturity, but limited loss if the stock price goes down at the time of maturity. Now, if somebody is taking a long position for buying a long call by giving a premium of 3 rupees, then there must be somebody who is selling a call, that is a short call position. So he is getting that 3 rupees from the buyer, and this is the profit of short call position when the buyer is opening the position. When the price is 103, the short call position will be at a break-even point, neither profit nor loss. When the price is 101, he is in the profit of 2 rupees. When the price is 102, he is profit of 1 rupee. But when the price further falls down, stock price falls down at the time of maturity, the profit of a short call position is limited to only 3 rupees. But when the price goes up, the stock price goes up at the time of maturity, like if it goes to 110, then that will be the loss for the short call position because the stock price is higher than the option cost. When the price is 120, then the loss of the short call position will increase because the holder of a short call position is obliged to pay to the buyer the profit with the rise in price, which will be the loss of the short call position. So in one line we can define a short call position that the short call position has limited profit when the prices are falling, but it has unlimited loss when the prices are rising. So from this explanation we can say that a long call strategy, the maximum loss of the buyer is the option price, the premium, the token which the buyer paid to come into the deal, but retains an upside potential, that is unlimited profit when the price goes up. Now let us compare the long call position with a long exit position. That is comparing option buying with a normal buying. On the ground of the given assumption, let us consider the price of an asset at the expiration date is 150. Now in option market, when we are taking a long position, we will be in a profit of 47 rupees, that is 150 minus 103. But in normal buying, profit will be 50 rupees, that is buying at 100 rupees, and now at expiration the price is 150, so profit is 50 rupees. But when the price goes down to 112, in option our profit is 9 rupees, and in long asset position, normal buying, our profit is 12 rupees. When the price further goes to 103, the option buying, the buyer of the option is having neither profit nor loss. He is at break-even point. But in normal buying, the buyer is in the profit of 3 rupees. If the price further goes to 102, option buyer will be in the loss of 1 rupee, but normal buyer is in the profit of 2 rupees. If the price further goes down to 101, option buyer will be in the loss of 2 rupees, while the normal buying there is a profit of 1 rupee. Now, the interesting part is here. When the price goes further down in the market at the time of expiration, the stock price is 101, the option buyer will not exercise his option. He will sacrifice the option premium and his total loss will be only minus 3 rupees. While long asset position, in normal buying, the loss will be 0. If the price falls down to 97 at the time of expiration, in option buying, the loss will be only limited to the option premium, the token amount what we have paid to the seller to get the right to buy. In long asset position, the loss will be minus 3. But when the price further goes down to 40 rupees at the time of expiration, the stock price is 40, the loss in option is only limited to 3 rupees, but the loss in the normal buying increases to 60 rupees. So here we can see that in taking a long call position, when the price goes adverse and falls down, the loss of the buyer will be limited to only option premium or the token what the buyer have paid to the seller to get the right to buy the option. So buyer will be only in the loss of option premium amount. But in normal buying, the loss will increase as there will be a fall in price. Now let us see writing a call option or selling the call option. So the profit and a loss of short call position is the mirror image of the profit and loss of a long call position. Or in a simple word we can say the profit of a buyer who has taken a long call position is equal to the loss of a seller who has taken a short call position, or vice versa. The loss of a buyer is the profit of a seller. So in other words, the profit of a short call position is same as the loss of a long call position. That is the profit of the seller same as the loss of a buyer. Now, the important point in writing the call option is that the maximum profit the short call position can produce is only the option price. But the maximum loss in short call position is unlimited as the price goes higher, because the seller is obliged to pay the buyer the profit when the price goes in favor of buyer. Now let us see the third and the fourth option position. They are buying a put option or long a put, or we can simply say at long put. The last is writing a put option or selling a put, or we can simply say it as short put. Now let us discuss the put option. Put option are of two types. Buying a put, that is long a put option, and writing a put, that is short a put option. Now to understand it more clearly, I am going to discuss the put option with an example. Now let us take this example to understand the put option. Here Mr. Bob and Mr. John want to sell their house. Mr. Bob deals in the option market and Mr. John deals in the normal market. So for Mr. Bob to get the right to sell the house, he has to pay the option premium of 2 rupees, where the strike price is 100 and the time of expiration is 1 month. So after 1 month there can be two probabilities. Number one is if the price of a house increases to 500, then what Mr. Bob will do? Mr. Bob will not sell the house in auction market. What will be his loss? His loss will be the minimum, that is equal to the option price which he has paid to get the right to sell. In second case, if the price of a house decreases to 50, Mr. Bob will be very happy to sell the house at 100 rupees and he will exercise his option. Mr. Bob profit will be 98 rupees. Now what happens to Mr. John? Mr. John has promised to sell the house at 100 rupees after a month. Now on maturity, there can be two probabilities. If the house price increases to 500, Mr. John has already promised to sell it at 100 and he will be in a loss of 400 rupees. But if the house price decreases to 50 rupees, he will be happy to sell the house as 100 and the profit of Mr. John is 50 rupees. So here we can see that Mr. Bob is getting the loss of only 2 rupees if the price in the market increases and his loss is limited to the option premium, while he has unlimited profit if the price of the market decreases. Now let us see buying a put option or long a put option with the help of another example. Suppose we are taking a long put option position for asset XYZ. Time of expiry is 1 month, strike price is 100, option price is 2 rupees, stock price is 100 and there is no transaction cost. Now the question is, what is the profit and loss for the investor who took a long put position and hold it till the expiry? Now profit and loss of a long put position at the expiration date will depend upon the market price of the asset at the time of maturity. Now let us compare a long put position with a short asset position, that is selling the asset in the open market. Now to calculate the profit of a long put position, we have to deduct the strike price from the option price, that is 100 minus 2, 98 rupees. So profit will be calculated on 98 rupees. Now consider the price of an asset at the time of expiration is 100 rupees. Put option holder will not exercise the option position. Put buyer will have a loss equal to the option price of 2 rupees. If the asset price is greater than 100 at the time of expiration, the buyer of a put option will not exercise it, because exercising would mean selling asset to the writer for the price less than the market price. So he will not exercise his option position and take a loss which is equal to the option price. If the price of an asset is less than 100 but greater than 98, put option buyer will exercise a net loss on the position. Exercising a put option limit the loss to less than 2 rupees. If the price of an asset is 98, long put position will be at a break-even point. If the price of an asset is less than 98, put buyer will realize a profit. But if we see a normal market selling, if a selling is done at 100 rupees and the price of an asset at the time of maturity is 150, then the seller will be in the loss of 50 rupees. If the price falls down and it becomes 100, the seller will be in a break-even position. But if the price falls down further, it will give profit to the seller who had sold the asset at 100 rupees. So here we can see that a long put position holder will be in profit when the price goes down, but he will take a loss when the price goes up. He will not exercise his option position and take a loss which is equal to the option premium amount. So his loss is limited to 2 rupees, but his profit is unlimited when the price falls down. Now, from the previous slide explanation, we can say that the profit and loss of a long put position at expiration date depends upon the market price of the asset at the time of expiration. Buyer of a long put position always compare the market price of the asset with the strike price. If the market price are higher than the strike price, he will not exercise the option. Now let us see the long put position with the help of a figure. The holder of a long put position has to pay option premium to get the right to sell. So he has to pay 2 rupees as option price. Now his profit and loss will depend upon the market price of the asset at the time of maturity. Suppose the market price is 98 rupees at the time of maturity. So the holder of a long put position will be at a break even, neither profit nor loss. But if the price increases at the time of maturity, he will be not exercising his option position and book the loss which is equal to the option price, the option premium. But if the prices are falling at the time of expiration, if the market price are less than 98 rupees, the holder of a long put position will get the profit by exercising the option. The profit potential of a seller of a put is substantial if the asset price falls to zero. So here we can see that in long put position, the losses are limited to the option price, but the profit are unlimited when the prices are falling. Now let us see the last option position, that is short a put, writing or selling a put option. The profit and loss profile of short put is the mirror image of long put option. The maximum profit from the short put position is option price, while the maximum loss in short put position can be substantial if the price of an underlying asset falls. That is, if the price falls all the way to zero, the loss would be unlimited in the short put position. Now let us see the figure of a short put option. Here we can see the holder of a short put position will realize limited profit when the prices are rising, but he will have large loss or unlimited loss when the prices are falling. Now in the last, let us summarize the option position with the help of a figure. Here I have taken a long position of call and put. Now the point to be noted here is that whenever you draw a long position, your figure starts from the negative axis, because for taking a long position you have to pay something as a option price or the option premium from your pocket. So here if you take a long call, you are paying option price to get the right to buy. So if the prices in the market are increasing, you will be in unlimited profit because you have paid this much amount as a right to buy at 100 rupees. So you will buy at 100 rupees at the time of maturity only when the prices in the market are increasing, that is stock price are increasing at the time of maturity. So you will be in unlimited profit. But if you are taking a short position, that means you are buying a right to sell. So buying a right to sell, you are paying a option price or option premium. Now if you want to sell the house at 100 rupees, you will sell only when the prices, the stock price at the time of expiration falls down. It comes in this axis, that is prices are falling down, then only you will sell the house at 100 rupees and you will have unlimited profit with the falling price. But if the price of a house increases at the time of maturity, you will not sell the house and you will not materialize, you will not exercise your option position and you take a loss, and that loss will be a very limited loss which is equal to the option price. Now let us see the short position. Short call and short put are the mirror image of long call and long put. So here in this figure you will see the short call figure. You will see the short call holder has a limited profit but unlimited loss. Why? Because this limited profit is the amount of money which is coming when a holder of a long call position is opening his position by paying a option premium. So the loss of long call position is the profit of short call position, which is exactly equal. And the holder of a long call will exercise his call position only when the prices are increasing and he will having an unlimited profit. So if the buyer is having an unlimited profit, the seller will be having a unlimited loss. Now take a short put position. What happens in short put position? In short put position, the profit will be limited and the loss will be unlimited. Now where this profit of a short put coming from? This profit of a short put is coming from the whatever the option premium price which has been paid by the long put position holder. Now as from the last example we have seen Mr. Bob has given 2 rupees as an option premium to sell the house at a strike price of 100. Now if the price of a house are falling, he will be very happy to sell the house, have unlimited profit. And if the prices of the house are rising, he will not sell the house and book the loss. So if the buyer is having unlimited profit when the prices are falling, the seller will be having the unlimited loss when the prices are falling. But when the prices are rising, the buyer or a long put will have a limited loss and a seller or a short put will having a limited profit. Now in the last slide I am combining the two option positions. First we will see short call and long call. The limited loss of long call is exactly equal to the limited profit of short call. But when the prices are rising, long call will have unlimited profit and short call will have unlimited loss. Now let us see the short put and long put. When the long put is having limited loss, short put will be having a limited profit which is exactly equal to the limited loss of long put. But when the prices are falling, the profit of a long put is exactly equal to the loss of a short put. If you have any question on this presentation, please leave your question in the comment section and like and subscribe my channel to get further notifications. Thank you so much.